Hey guys, Mike here. So I got a jam-packed video for you, and we're going to get into, what you're seeing happening with inflation right now with these gas prices, which, hint, hint, hit a new 2023 high there, okay? I don't know if you're feeling that at the pumps yet, or even noticed. Then we're going to get into this $600 billion short bet that's happening right now in an area that you really don't want to see anything bad happen to, okay? Because the world doesn't function without this part of our market and stuff. And then we'll get into the flows you're seeing come into the market, all the different charts and stuff, which are very interesting to see today. As a matter of fact, setting us up for what? FOMC tomorrow, right? 2 to 2:30. We'll talk about that at the end right here. Now, you can see our friends up in Canada, inflation has been increasing here a little bit. Well, it ain't just here, it's in Canada as well, right? So gas prices are driving theirs up as well. And so we talked about, it affects many different things, right? These oil prices and stuff. And you can see right there, new 2023 high. So we're hitting $4 a gallon right now. It's not even really that kind of gas. It's diesel you want to more or less focus on. But I know it upsets people like myself. And hey, look at this way though. Here's the positive. You remember this right here? You remember when we were at $5 a gallon right here? I mean, seriously. So definitely should not be going back there. So that's a good thing. I mean, I remember those days of going and saying, how much did it just cost me to fill up my tank? So we're not going back there. But again, as long as you got these freaking cartels cutting what they're going to put out here in America, they won't drill and do anything else because they say they're not making money if they do. Even though it is shocking when you look at this, I guarantee if you took a poll in America, I would bet 90% of Americans would guess Saudi Arabia was the #1 oil producer and not the United States. So let me know on the bottom what you would put on that poll right there. I mean, they probably say Russia too, but I don't think anybody would say the U.S. because we act like we're just oil poor, to be honest with you. And I'm curious here, and keeping politics completely out of it, just try to be as independent a thinker as possible, especially if you know a lot about oil and gas, things like that. Like, you remember it was $5, right? What do you think? I'm just curious in the comments. What do you think brought down gas prices like it did? 'Cause you saw that chart, and they fell pretty fast, right? It's still obviously historically high, but they're not $5, right? And they went under $4, like $3.50, pretty fast within months. So what do you think did that? I'm just curious to know what you think brought down oil prices and stuff. Now, speaking of this short bet, right? As I told members, you got hedge funds now risking financial turmoil by shorting $600 billion in what? Treasuries. Yes, they're shorting treasuries here. $600 billion. Now, you think to yourself, the treasury market's huge, but the problem is, and what's got people worried here, obviously hedge funds depend on borrowed money, right? So margins and everything. So if they're suddenly forced to put up more collateral to hold these shorts, then of course the bond market see a huge sell-off, which is something you don't want to see, as the likes are saying of like the pandemic 2020, which would be disastrous. And the big thing to look at is this right here. Before the pandemic, the initial margin requirements, all about leverage, folks, similar to the security deposit you need for a loan, to borrow treasuries was quite low. This allowed traders in the treasury market to operate with a leverage as high as 175 and 120 times the value of their initial deposits for 5-year and 10-year treasuries. However, with increased volatility in the treasury market in 2021, the margin requirements tightened. Despite this, trading leverage remains elevated, 70 times the initial deposit for the 5-year treasuries and 50 times for 10-year treasuries. And you can see you got hedge funds on one side and asset managers on the other, right? Total opposite camps here when it comes to the 10-year. And you can see asset managers all about it. They're long in it. And you can see hedge funds like, oh no, we're short. And why is this a bad thing? And guys, if you get anything out of this, please hit that like button. It helps people find this video. And if you like the content, think about hitting that subscribe button down in the bottom. Because to put it simply, the bond market is everything. Okay, the stock market would go to zero without the bond market. These companies could not at all finance their expenses and what they're doing on a day-to-day basis. You're talking about around the globe of 133 trillion is what the bond market is valued at. In America, it's like 46 trillion. To give you an idea, you compare that to the stock market. The stock market's market cap is about 30 trillion. So you're talking about a $17 trillion difference, but that don't even matter. It's just all about what does the bond market do, right? Obviously, these companies are selling bonds to continue their growth. So if something happens to the bond market, and this is what the Fed would protect more than anything else, it will be disastrous. Okay, absolutely, especially here in America. I'll show you a chart tomorrow. It wouldn't even affect Europe anywhere near as much as it would us, and I'll show you what I'm talking about with this chart and stuff. compared to how we do our financing here. But it will be absolutely catastrophic if something were to go wrong in the bond market, which that's what everybody's kind of waiting on. They're kind of looking at going, if you keep these rates high and stuff for a long period of time, something's going to break. And that's what people are worried about breaking. Okay, so just keep that in mind. Now, when it comes to the 10-year yield, you can see it actually peaked up today for a new high we hadn't seen since like 2007. Again, if when you look at this chart, I mean, does it look like it's going to come back down? You got to think so, especially it depends on what the Fed is going to tell us tomorrow and everything. But if it continues to go higher, that's bad for equities. Now, when it comes into the weekly inflows for equities, right? We saw the largest weekly inflow we've seen since March of 2022. Why? I mean, is this like one of those things where it's just, okay, retirement accounts are getting filled, all that good stuff? Or is it a setup? It's okay, let's go ahead and start getting in now, try to prep for the fourth quarter? That's a good question, but I just want you to see inflows are coming in, right? Now, looking at the S&P, what do you got here? Obviously, this trend line right here, which we talked about, it actually got a little beneath this morning, recovered, got back above it and everything. So you get like a third bounce right there. And, you know, above, you got two huge gaps that are setting up, right? You're sitting here. This head and shoulders, though, is still in play. Let's not forget that right there. And you see that would be the neckline if it came down and broke. Again, anything below like 439 is bearish, okay? And that could take us down probably like, I mean, anywhere from 424 to 432. But, you know, keep that in mind. But when we look at this, from a different perspective, what have you been seeing since July, really, right? Lower highs. But you haven't been getting the lower lows, so to speak, right? What do you see on the RSI daily? Below the 50. MACD is threatening to go below the zero line. Those are not good things if you're looking at, you know, what's going to happen over the next week or two. But then again, when you look at it from a different perspective, if you look, we've been trading this 2% range since September began. I guess if you back to August, it's really about 2.5% range. And so you're in like this short-term downtrend inside a long-term uptrend. And when you look at the hourly, what normally happens when you get oversold, which is what what happened yesterday, you try to get some kind of bounce, right? You see right here, nice little bounce up right there. Then in this one, you're oversold. Again, you get a slight bounce, then it continues to sell off. Then we come over here, you can see right there, end up getting a nice little bounce, which continued for quite a while right there. Again, this was when it was in the uptrend. Here you're oversold. Same thing happens, okay? So let's just see, again, a lot of this will go off what the Fed says, or more importantly, what the market believes the Fed is going to do, or trying to guess, or how they take it in. So we'll see if it's a sell the news event. Now, IWM, still a hot mess. Still got this beautiful head and shoulders playing out. It is below the 200 moving averages. It's below the year-to-date anchor VWAP. So it's below all its moving averages. The 50 is starting to curl over and start to point down. Again, it's starting to approach right into this volume gap right here. So, you know, this one right here, it just looks like a mess. If it don't continue to go down, I'm going to be surprised. And the only way it's going to get saved, honestly, is what the Fed says tomorrow. That's the only way that would happen. And so if the market deems it as bullish, then you're going to see IWM probably take a good bounce. If not, watch out down below. Now, NVDA, like we told you yesterday, it got the bounce right there on that ascending trend line in this channel right here. It went down this morning, recovered very quickly. Again, slightly red, and I mean, semiconductors have been under a lot of pressure lately. But again, is this one going to hold this support line right here? You can see it's got nice support there. And we start heading to the upper line. That's really the big question. Again, we got about 2 more weeks of bearishness in the market until you hit the fourth quarter, which of course is considered, if you're new here, seasonal strength. Now, what happened to AMD here? We talked about that year-to-date anchor VWAP. It popped. It's still trying to hold right here. Again, you're going to have resistance right there. If it gets in that volume gap, it can go to 104, but you got a lot of resistance above it right now. And this one's going to follow NVIDIA. Wherever NVIDIA goes, that's pretty much what you're going to see AMD do, as I've showed you the chart before. And then when you look at Netflix, you can see, I mean, a lot of people calling for a lot more downside of this. I'm like, look, until it fills this gap and breaks this trend line right here, which is going all the way back to July of 2022, where you got multiple bounces, as you can see right there. You know, I don't see anything to worry about at this point in time. Do I think it's going down there? Absolutely, I do. But, you know, if it breaks down right here, obviously that trend line I've been talking about, you know, 367, if it breaks that, then you're going down to 343. Sorry for the terrible writing there. I mean, look at Tesla, not too much to report here. I mean, it was red on the day. It went green at one point in time, trying to fight its way back. It fell below that trend line. As you can see, the dotted trend line there. got support, caught support right there where it needed to. And what you're looking at on this one again, is it going down to fill the gap below, or is it going to fill the gap above and hit that trend line? And right now what you're looking at, if it does fail right there, that support around 363, I believe it is, then yeah, we're going to fall down in that gap where it has plenty of support in that gap before you get the bounce. But again, the call sweepers were hitting the tape today, which is what saved Tesla from going down even further today. So I think there's still a lot of bullishness in this one. Now, I love this because, Microsoft got hit, Apple got hit. Now the question is it going to be Google or Amazon? And when you look at it, which one are they coming for next? It looks like Amazon, really, when you look at this right here. We talked about yesterday getting a bounce off this trend line here. Actually fell through the trend line, ended up hitting that 50 moving average and that support right there before it got its bounce. And if we can hold that support, let's see if we can get back to 138, then 141. If not, obviously we're heading down to 132, then 128. Now, Google, this has been a lot of money basically rolling into this. It's inside this rising wedge still, and it did what Apple and Microsoft did. It just left behind a graveyard of gaps right here as it's moved up and everything. And so is this due for a pullback? I mean, I would absolutely say it is, because when you pull out, what happens when you start to get to all-time highs, as we saw with so many other stocks, you start to get, pullbacks. That's what happens. That's normal, okay? And so, would it be good to go down, get a bounce off that 50 moving average maybe, bottom of that trend line? Yeah, that would be smart. So let's see what happens, or if money continues to rotate into Google. Now, Disney, I'm just going to mention this because obviously big red day for it. Ran into that 50 moving average, which obviously is pointing down now. And when you look at this one, to keep it simple, here's the weekly. Look at this thing. That is a mess. I mean, this thing has to reverse course and at least break this, at least get above that trend line right there, to try to break out, go above the high that's right beside it, to try to show something of some life here of getting out of this downward trend on the weekly. And so, again, you've seen the moving averages, and this is just one of those ones, if you really like it, it's a great time to consolidate, right, and buy it up, I guess. Man, a lot of people are doing that, right? I put PayPal in the same thing because look at this weekly. It's still in this downward trending channel right here. It still has not, really showed the life. It's trying to base out. It's trying to go in, the phase one before you even get to phase two. But both of them are just hated stocks right now, right? So you just got to see big money come in. So when we get the hedge fund reports coming out of the third quarter, we'll look to see if these were two bought up stocks, right? That's what you got to look for. Now, Shopify, as we talked about, which way is it going? Well, it's going down, right? So 3 red days in a row, sitting there hitting that 58.30 level right there. If that's not going to hold, going down to the 200 most likely. It loves this pattern where it loves to come down. It never did fill this gap right here, right? So you still got that volume gap. But this thing is religiously, you see it pop up. It'll go between like 60, 65, come back down, threaten to go into the 50s again, come back down again. And so, you see this thing, it just can't get above 71, but it loves to come back down into the high 50s before it gets this bounce right here. So we'll see, where this thing goes from there. And you can see the MACD and RSI, right? Not looking good at all. Now, when it comes to earnings tomorrow, we'll get General Mills because we want to see, they're still able to raise prices, what they're seeing in consumers, then FedEx and KB Homes, and we'll see what the home builders got to say because a lot of data came out today, which I'll tell you guys about tomorrow. Now, you end up with a lot of mortgage data, but all that matters tomorrow is going to be at 2 o'clock. They'll decide their interest rate hike, which so far is a 0%, I think it's 1% chance, they'll do that, and that would shock the market if they did, and they don't tend to shock the markets. But more importantly, their projections, right? And then you get the press conference where Jerome Powell would just bounce around the questions and probably say the same thing he always says, and the market's going to interpret it how it wants to interpret it, and it'll shoot up and shoot down and go, oh my goodness. But it's all about this pause, right? And I put a video out for the members today talking about the power of the pause, showing them exactly what I'm talking about when it comes to treasuries, futures, the Qs, you name it. You can see it is right there, okay? And so, I mean, that's what the market's just begging for. Again, it's like a freaking drug addict needs a fix, and that's just, liquidity is the biggest fix. And that right there, that Fed pause, where they're not going to go up anymore, it's kind of a form of liquidity, right? Because they keep going up in rates, it's taking liquidity out. And also you get to see like this end. You go, oh, okay, and what's the next step? Oh, they'll cut at some point in time. Remember in 2018, actually it was the beginning of 2019, they started to cut rates. We were not in a recession at that point in time. That was the taper tantrum deal, right? Where Trump was beating Jerome Powell up every day in the press, and he finally caved. and he lowered rates, right? When we went in a recession, every other time you usually see we're in a recession, okay? Because you got to remember, I mean, before the 21st century, it was actually normal to be setting between 5 to 7.5% rates, and the economy was still growing, the market was still functioning, okay? That's before we got all this leverage involved, all these shenanigans that take place now before the government started taking over the markets. And so it's, as you see, you saw the growth, right? A lot harder to grow with rates now. Okay, there's a reason for this, and I'll talk about it some other time. But that's what it's all about tomorrow. We'll see how it goes. You see all these bearish formations on these charts. Well, if the market loves what they hear, we know how that easily gets solved. If it's a sell the news event, those bearish patterns will play out. Okay, and so remember, we're definitely in September. I mean, coming in the end of September, and then you start to get to a bullish seasonality starting somewhere in the fourth quarter, usually in October at some point in time. So, let's see how this plays out and see how it goes. Let me know what you think down in the comments and stuff. Do you think it's the pause, or is it not a pause? Do you think we got one more rate hike in us, or not, right? So please hit that like and subscribe button. Appreciate all you guys for watching. Always appreciate all your support and stuff. Feel free to sign up for the membership. If you like videos like the one I put out today for the members, let me know. You get a 7-day free trial and stuff. So go through there and check them out. It's things you can use for the rest of your life. That's how I like to put out. So anyway, have a good one, guys. See you tomorrow.